Hello and welcome to another educational video brought to you by Liteforex. My name is Michael and today's topic is a currency pair correlation. So let's start from the basics. Correlation occurs when one trading asset repeats the directional movement of another instrument. And there are two types of correlation. The positive, where the price movement of both assets goes in the same direction, for example, both are in uptrend. And the negative, when the price of both assets move in opposite direction of each other. For example, one is in uptrend and the other is in downtrend. I should also mention that a currency can correlate with other assets, like for example Canadian dollar and crude oil are in very strong positive correlation. When the price of oil goes up, so is the rate of Canadian dollar against other currencies. Now let's check how we can calculate the strength of a correlation. And to do that, we will use a special calculator, which you can find in the article on the Liteforex blog on their website. Or you can just Google it, there are many freely available calculators on the internet. So now, if we talk about the direct correlation, the value goes from 0 to 1, where 1 means that the correlations is very strong. The assets are heavily correlated. And it goes the other way when we talk about the inverse correlation. The value goes from 0 to -1. So, let's check some example. We have the Euro-USD currency pair. Right here you can check any other currency pair you want, but we will stay with Euro-USD time frame. Here you choose the time frame. The numbers from 1 to 240 represents the minutes, like the candles in the trading platform, which is 60 minutes, 240 minutes, which is 4 hours, right? Next we have D, which is day, W, week, M, which represents month. Next, the amount of. And this value goes from 10 to 300 and it represents the amount of the periods from the previous time frame. So now let's check some example. Let's choose, for example, 60-minute time frame and the amount of 200. It will represent the analysis of the correlation from past 8 trading days. Click calculate, and now we see with which currency pairs Euro USD is most directly correlated and most indirectly correlated. We can see that it is Aussie dollar against US dollar, and inverse correlation is against US dollar against Danish crown. Another feature of this calculator is when you click on this little icon right here. For example, let's choose the first currency pair, and right here the USD against Swiss franc. Click on this little icon and down below you will see the chart comparison, the direct correlation, and below the inverted correlation, which is clearly visible. So that's it from the calculator. And lastly, we get to the most important point for all of us, meaning how we can use those correlation in trading. First, as a confirmation, when opening a position, before opening a trade, we can make sure that the directly or indirectly correlated currency pair or asset is moving in the right direction. Second, for risk management, there is no sense of opening an additional trade on a currency pair which is heavily correlated with the one you already have opened trade. By doing this, you're just doubling the risk. On the other hand, when there is a less correlated currency pair to the one we have opened trade, you could consider opening another trade on additional instrument to diversify the risk. So, in resume, correlation between assets is not a constant factor, so you shouldn't depend only on this type of analysis, rather it should be an additional filter in your decision-making process. So guys, that's it for today. See you in the next one. Take care.